Welcome back to the Deep Dive. Today, we're really digging into something specific. It's the 2020 Shareholders Letter from a major financial holding company.
Right.
And 2020, I mean, what a year. You could say it was the ultimate kind of black swan stress test for pretty much everyone, couldn't you?
Oh, absolutely. The ultimate test. Think about it. You had over 180 economies, like literally shutting down.
Yeah.
And the S&P 500, it dropped, what, 30% in just 12 days back in March? Just breathtaking speed.
Insane.
And for this company, their whole mission, really, it isn't just about weathering storms like that. It's about navigating that uncertainty, compounding value over the long, long term. And they do it using that insurance float to fund their value investment.
Right, the float. We'll definitely get into that. So our mission for you today is basically to unpack how they pulled through 2020. We want to show you how their structure held up, how the insurance core stayed profitable despite, well, massive COVID losses, and maybe most interesting, the CEO's pretty strong warning about market speculation and what he calls the coming renaissance of value.
Yeah, that's a big one.
Okay, so let's start right there at the point of impact. March 2020. The market tanks 30%. You'd expect, catastrophic mark-to-market losses for a company like this.
You absolutely would.
Yet somehow, they absorbed it. They ended the year reporting actual earnings of $218 million.
That's remarkable.
And get this, they even managed to nudge up their book value per share by 0.6%, even after paying out a $10 dividend. How is that even possible with that kind of market chaos?
Well, it really boils down to two key things they emphasize in the letter: structure and culture.
Okay.
This wasn't just luck, right? The letter gives a lot of credit to their decentralized structure. That's what allowed something like 15,000 employees worldwide
15,000.
to just switch to remote work almost instantly without missing a beat, I think was the phrase they used.
That's impressive coordination.
Right.
Or lack of central coordination. Maybe.
Exactly. It wasn't some top-down mandate. It was the decentralized leaders, people like Peter Clark, the COO, and Jen Allen, the CFO, just responding on the ground.
And you mentioned culture. There was a human side, too, wasn't there? They made a point of saying no layoffs in insurance because of COVID.
Yeah, they did. And that speaks volumes, doesn't it? Especially under that kind of pressure. It shows the culture isn't just talk.
Right.
And that culture, well, it becomes a real financial safeguard in a crisis. They went into 2020 very conservatively financed. That's actually one of the characteristics they highlight, something common in companies that last for, a century or more.
So practically, what did conservatively financed mean for them in March 2020?
It meant having firepower. They had about $1 billion in cash and marketable securities just sitting at the holding company level.
$1 billion, ready to go.
Ready to go, plus another $2 billion in credit lines they hadn't even touched.
Wow.
That pool of capital, that's your defense. But it's also what lets you go on offense when everyone else is just trying to survive.
Okay, that idea of being conservatively financed, it leads us straight to the heart of their operation, right? The insurance business.
The engine room. Yeah.
So when we talk about insurance profits, the metric everyone uses is the combined ratio. Just quickly, for listeners, what does that number actually tell us?
Right. The combined ratio, it's basically the scorecard for underwriting. Simple as that.
Okay.
It adds up your losses from claims, that's the loss ratio, and your costs for running the business, the expense ratio.
And the magic number is 100.
Exactly. If you're below 100, you're making an underwriting profit. You're literally being paid to hold the premium money before you pay out claims.
And their number for 2020?
Consolidated, it was 98%. So profitable.
98%. Okay, profitable. But wait, that 98% feels almost misleading? Because COVID hit them hard, didn't it? How big were those losses?
Oh, huge. We're talking $669 million, specifically from COVID-19.
Wow, $669 million.
Yeah, and that single hit added 5 full percentage points to the combined ratio.
5 points.
So if you sort of mentally take out those huge one-off pandemic losses, which, by the way, came mostly from business interruption claims outside North America and event cancellations.
Right, like concerts, sports, that kind of thing.
Exactly. Mostly through their subsidiary Brit, actually. If you strip out those COVID losses, their underlying combined ratio is actually down at 93%.
93%. That's That's exceptionally good, isn't it?
It's very strong underwriting, yes.
You mentioned Brit took the hit on event cancellations. Their combined ratio must have suffered.
It did. Brit hit 114%, so quite unprofitable. But again, take out COVID, and even Brit was back down around 98%.
Okay, so even the hardest hit part was fundamentally sound underneath.
Yeah.
What about the others? Did the rest of the group show that underlying strength?
Oh, absolutely. That's where you see the consistency. There are other big subsidiaries, Allied World, Odyssey Group, Northbridge. They all turned in really strong performances. Well, Allied World was at 95% combined, with 22% growth in premiums. Odyssey Group, also 95% combined, 15% growth. Northbridge, even better at 92%, with 14% growth.
Okay, so across the board, disciplined underwriting seems to be the theme, despite the specific COVID shock.
That's the takeaway. Deep, consistent, decentralized ability to underwrite well.
And all this was happening while the wider insurance market was changing, right? They mentioned a hard market. Rates were going up.
Yeah, significantly. And accelerating through the year. Property and casualty rates were up like 12% in the first quarter. But by the fourth quarter, increases were hitting 16%.
16%. Why the big jump?
It's a combination of things, really. COVID uncertainty was a big driver, obviously. More catastrophes like hurricanes and wildfires, but also something they call social inflation.
Social inflation? What's that?
It's basically the rising costs of legal defenses and bigger jury awards and liability cases. Think lawsuits getting more expensive and payouts getting larger.
Ah, okay. So all that pushes insurance rates up.
Right. And higher rates mean potentially more profitable underwriting for the policies they were writing then.
Which brings us back to the float. More profitable underwriting means that capital is even cheaper, or better than cheap.
Yeah.
How big was the float by the end of 2020?
It stood at $24.3 billion.
$24.3 billion. That's a massive pool of capital.
It is. And here's the kicker, the real financial magic. Because they were making that underwriting profit, that 93% underlying combined ratio,
Yeah.
the actual cost of holding that $24.3 billion float in 2020 wasn't a cost at all. It was a benefit of 1.4%.
Wait, a benefit? They were paid 1.4% to hold $24 billion.
Essentially, yes. Think about that. They get paid to hold billions, which they can then go and invest.
That's credible.
And it's not a one-off. Over the last 10 years, they calculate this has given them a 3.4% advantage compared to what, say, the Canadian government pays to borrow money. It's just fundamentally cheaper capital.
Okay, so generating $24 billion in cheap, or even better than cheap, capital is one thing. But deploying it wisely, that takes a different skill set, right? Patience.
Patience is the word. Their whole investment philosophy, they highlight this quote from Phil Carrot, boils down to one thing: good management, led by an outstanding CEO.
People first. They're investing in the leadership.
Exactly. They believe that's the single most important factor, and that demands, well, enormous patience as an institution.
Can you give an example of that patience in action?
Sure. Look at Odyssey Group. That's one of their big insurance subsidiaries we mentioned. It's been part of the group for 25 years. And in that entire time, it's only had 2 CEOs.
25 years, 2 CEOs. That's stability.
Incredible stability. And look at the result. Gross premiums grew from $215 million back in 1996 to $4.3 billion in 2020.
Wow.
That kind of long-term growth, it just doesn't happen without backing consistent, stable leadership for decades.
They also showed they know when to sell, though. They talked about selling Riverstone Europe. What was that about?
Right, Riverstone Europe. They're in the runoff insurance business, basically managing old books of insurance policies that are no longer being written.
Okay.
They actually got into that business initially to handle an internal problem from an old acquisition, Sphere Drake, that had performance issues. But then they smartly pivoted.
How so?
They turned it into a business acquiring other companies' runoff portfolios. They did over 20 deals like that, built it into a leader, and then sold it very profitably in 2020 for $1.35 billion.
So turning an internal problem into a profitable external business, then cashing out. Smart.
Very smart. It shows strategic flexibility. And speaking of strategy, emerging markets are a huge theme, especially India.
Yeah, they seem really excited about India post-2014. Why then?
It comes down to policy changes under Prime Minister Modi. Things like privatization, big infrastructure spending, and crucially for them, raising the limit for foreign direct investment, FDI, in insurance up to 74%.
74% foreign ownership allowed now.
Okay. They see it as transformational, a real pro-business, pro-growth shift creating opportunity.
But isn't that risky? Placing big bets on one emerging market. India has its complexities, regulations. Execution risk must be high.
That's a fair point. And yes, the risks are there, but their approach seems to be mitigating it by backing what they see as very strong, resilient local assets with great management.
Like what?
Well, take Digit. That's an Indian insurance company they back.
Ugh.
It was expected to grow premiums by 40% to $400 million in the following year, and it got a $1.9 billion valuation in a 2020 funding round. Explosive growth.
Okay, high growth potential there. What else?
Then there's Bangalore International Airport, BIA. Talk about resilience. The pandemic basically shut the airport down for months, right?
Air travel collapsed.
But the long-term valuation of their stake, about $1.4 billion worth, they say it remained unchanged.
Unchanged. How does an airport shut down and not lose value?
It's the concession agreement. It's a fascinating setup.
Explain that. How does it work?
Think of it like built-in shock absorption. If traffic drops and they lose revenue in one period, like during the pandemic shutdown, the agreement basically says the concession period gets extended. It just stretches out until they've had the chance to earn their originally targeted returns.
So it kind of pauses the clock on the investment's viability during a crisis.
Exactly. It protects the long-term value proposition from short-term shocks. Really clever structure for infrastructure assets.
They're not just buying old economy assets, though, right? I
Wow.
saw a mention of tech innovation.
Correct. They highlighted the launch of Brit's Kai Syndicate. This was done with Google Cloud.
Google, okay.
It's billed as the first fully digital, algorithmically driven syndicate at Lloyd's of London, aiming for $300 million in premium in its first full year, 2021. So yeah, definitely investing in insurtech and efficiency too.
Okay, one last technical point before we get to the market warning. They talked about accounting buckets for their stock. Sounded a bit confusing.
It can be, yeah, mark-to-market, equity accounted, consolidated. It's accounting stuff. But the key takeaway for you, the listener, is really simple and speaks volumes about their philosophy. At the end of 2020, the actual market value of all their common stocks added up about $9.1 billion,
Okay.
was less than the value they were carrying those same stocks at on their own books, which is about $9.8 billion.
Wait, so the market was saying their stocks are worth less than they themselves believed they were worth?
Precisely. They were effectively sitting on unrealized losses on paper, but holding firm because they believed the true intrinsic value was much higher. It perfectly illustrates that buy and hold patient approach.
Right. And that patience, that belief in underlying value sets up this really stark warning from the CEO about the rest of the market.
It's pretty blistering, yeah. He doesn't mince words about the speculative mania he saw building in 2020. And he draws some pretty scary historical parallels.
Scary how? What periods is he comparing it to?
Not just the obvious dot-com bubble of 99-2000. He actually reaches back further to the Nifty 50 crash in 1974.
The Nifty 50. Wow, that was a brutal unwinding for those supposed one-decision growth stocks.
Exactly. And he uses some specific, almost jaw-dropping examples from 2020 to make his point about valuations.
Like what? Give us a couple.
Okay, he pointed out Zoom. Market value of $130 billion on revenues of just $2.7 billion.
130 billion. Okay.
Or Shopify. Its market cap actually got bigger than the Royal Bank of Canada's.
Canada's biggest bank.
Yeah. Despite the Royal Bank earning more profit every year than Shopify had in total revenue.
Yeah, it's hard to wrap your head around.
And then just the dominance of the big tech names, the FAANGs, making up such a huge chunk, like 40% of the S&P 500 index. Extreme concentration.
Right. And his prediction based on all this.
Pretty blunt. This will end and it will not be pretty.
Okay, so if you think a storm is coming, you prepare. How did this view shape their strategy, particularly around interest rate risk? Because rates were scraping bottom in 2020.
Rock bottom. Lower even than during the Great Depression in the 1930s, which is saying something. But they saw huge risks on the horizon. You had massive personal savings built up during lockdowns, huge pent-up consumer demand ready to be unleashed.
Right, revenge spending and all that.
And governments, especially the U.S. with its $1.9 trillion plan, just pumping stimulus into the economy, all pointing towards potentially much higher inflation and interest rates down the road.
Okay, so risk of rising rates. How did they position their bond portfolio then? Did they try to lock in yields or stay flexible?
Very, very flexible. Defensive, really. Their bond strategy was built around two things: super short duration and super high quality.
How short?
Average duration only 1.8 years.
Wow, that's incredibly short. Basically, cash equivalents almost.
Pretty close, and the average credit rating was AA, very high quality.
But wait a minute. By keeping duration that short in a zero-rate world,
Hmm.
weren't they giving up a ton of potential income?
Oh,
Isn't
yeah.
that a massive opportunity cost just to play it safe?
It absolutely is an opportunity cost. In terms of current yield, yes, that's the trade-off. But they see it as insurance
Insurance against what specifically?
against rising rates killing bond prices. They ran the numbers. If rates go up just 1%, a typical 30-year bond could lose 22% of its value.
22% wiped out by a small rate hike. Ouch.
Exactly. By keeping their duration at just 1.8 years, that same 1% rate hike barely touches their principal value. They're prioritizing preserving capital over chasing those last few basis points of yield. It fits that whole conservative financing ethos we talked about.
Okay, makes sense from a risk perspective. But they weren't totally hiding, were they? Didn't they do some buying during the crash?
Oh, yeah, they weren't passive. When the market panicked in March and April, they definitely stepped up. They made some pretty significant opportunistic buys.
What kind of company?
Things like Exxon, some Canadian banks, Alphabet, Google's parent FedEx, solid companies that got hammered in the panic.
Right, so classic value investing. Buy when there's blood in the streets.
Sort of, but this was more tactical, actually, not necessarily long-term holds. They revealed they sold about half of those positions later in 2020.
Already? Why so quick?
For a quick profit, they made an average gain of around 40% on what they sold.
40% gain in just a few months. Nice.
Very nice. It shows they're prepared to be nimble and capture short-term dislocations, even while their core strategy is long-term patience. It's about acting decisively when fear peaks.
Okay, before we wrap this up, we should probably touch on some of the softer stuff, the cultural aspects and social responsibility bits that they highlighted.
Yeah, important context for their longevity.
We already mentioned the no layoffs commitment in the insurance side due to COVID. That's big.
It is. And that sense of responsibility seems to extend beyond their own walls. They detailed about $4 million in special donations specifically for COVID relief.
Where did that money go?
Mostly to food banks all around the world where they operate, addressing immediate needs.
And they mentioned involvement in social justice, too.
Yeah, in Canada, specifically Toronto, they're involved with the Black North Initiative. It aims to tackle systemic anti-Black racism. They even set up their own internal Black Initiative Action Committee to drive change within the company.
Interesting. And the long-term stuff in India.
That continues. They've been funding a children's hospital there with CMC Vellore for years, and they mention installing 500 dialysis machines specifically for the poorest citizens who can't afford treatment. Real on-the-ground impact.
So connecting this back,
Yeah,
the letters sort of framed these actions as part of why they've lasted.
exactly. They close that section by listing 4 characteristics they believe are common to companies that survive for over 100 years based on studies.
What are the 4?
1, being sensitive to the business environment, so adapting. 2, having a strong cohesive culture. 3, being decentralized. And 4, being conservatively financed.
And I guess their point is 2020 tested and validated all 4 of those pillars for them.
That's precisely the message. The crisis proved the model.
Okay, so let's pull this all together for you, the listener. What's the big picture here? 2020, ultimate black swan event. It didn't break their model. If anything, it proved it out. This decades-long strategy of pairing conservative, profitable insurance, the float machine, with patient, decentralized value investing. It worked. It absorbed a global shutdown, market panic, everything. It passed the ultimate stress test.
And the long-term results, well, they really speak for themselves, don't they? Since 1985, their book value per share has compounded, including dividends, at 18.7% per year.
18.7% annually for over 35 years.
Yeah. That's serious wealth creation. And it fuels their conviction, which they state very clearly. They believe the company's true intrinsic value far exceeds book value.
Right. And that gap, that tension between the crazy speculative market we saw in 2020, maybe you still see now, and this company's deep-seated patience. So that feels like the core takeaway here.
It really is. And maybe here's a final thought, something provocative for you to chew on.
Okay.
The CEO didn't just write about his conviction that the stock was undervalued in that letter. He acted on it, big time.
How so?
He personally bought almost $150 million worth of the company's shares himself during the summer of 2020.
$150 million of his own money.
Yep, putting his money where his mouth is. And beyond that, the company itself entered into something called total return swaps on its own stock.
Total return swaps. What's that?
It's basically a leveraged bet that the stock price will go up. It's a very public, very confident signal from management that they believe their shares are fundamentally undervalued.
So personal buying by the CEO and the company itself making leveraged bets on its own stock recovery. That's a strong statement.
It's about as strong as it gets, ultimate conviction. As the CEO quipped in the letter, talking about the gap between their value and the stock price, nothing that a $1,000 share price won't solve.
$1,000 share price. Okay.
It's a bold target, maybe tongue-in-cheek, maybe not. But it perfectly captures their belief in the ultimate reward that comes from sticking to their knitting, focusing on value, and just being patient.